Wealthion's endorsed financial advisors at https U.S. Economy in a Balancing Act, Schrodinger's Recession? By Wealthion. Monday, October 21, 2024, 15:20. Wealthion's Andrew Brill sits down with Variant Perception CEO, Tian Yang, to unpack his intriguing concept of a Schrodinger's recession, where the U.S. economy continues growing despite traditional recessionary signals flashing red. Tian also explains why the Fed's preemptive rate cuts were the right move and how resilient household balance sheets have helped the economy avoid a downturn. He also discusses China's economic struggles, recent stimulus measures, and why the latest Chinese market rally may be short-lived. Are these factors enough to keep the U.S. on track for a soft landing? Investment concerns. Get a free portfolio review.
The key is that this is not a normal business cycle. This is the post-COVID business cycle, where there are literally some things that have not been seen, in recent history. We've weathered a lot of the drags that would have historically resulted in a recession. We crossed the Rubicon. Fiscal policy is okay again.
Third quarter earnings season rolls on. I'm your host, Andrew Brill. We'll talk about where the economy is headed and the possibility of a recession coming up right now. And if you need help being financially resilient, head over to wealthion.com/free for a free, no obligation portfolio review. I'd like to welcome in Tian Yang, Head of Research and CEO of Variant Perception. Tian, thanks for joining me. Can you tell us a little about yourself and your research and proprietary models you use for investment advice?
Hi, Andrew. Very glad to be here. So what we do at Variant Perception is that we try to simplify down macro and the capital cycle. So we take lots of different factors like growth, inflation, policy, liquidity, the things that kind of should matter for investing, but try and abstract it down to actionable tools to generate portfolios. So I think in terms of how to categorize us, I would say we're kind of more top down than bottom up, and a lot more data and quantitatively driven than, finger in the air insights. So that's probably how I would frame ourselves.
I appreciate it. I've read a bunch of your reports, and I appreciate you because I know this is all very technical, and I appreciate you dumbing it down for people like me that can ingest it and read it and understand it a little bit. But they are great reports. And I want to start by asking you your take on the present economy here in the U.S., and then we'll get over to China as well.
Well, first of all, certainly, I wouldn't want people to think that this is just for people who think they're super smart, right? I certainly don't think of myself as that. I think the goal is to essentially figure out which are the parts of the economy that we can model that are repeatable over time, and essentially model that. And then that leaves kind of the room to understand how is today different or not to kind of the past. So, and obviously that leads us very nicely as a segue onto the US economy. So clearly there's a lot of differing opinions out there. I would say pretty polarized opinions on the economy. It's probably not a coincidence that, if you look at consumer confidence surveys and the like, they've become much more polarizing and actually less useful to predict the economy in recent years. So I think if this was a bog standard business cycle, there would be a lot of things that are concerning about the US economy, right? In terms of some of the labor market statistics and things like that. But the key is that this is not a normal business cycle. This is the post-COVID business cycle, where there are literally some things that have not been seen, in recent history, from the very large fiscal deficits, the large control the government has, the prevalence of industrial policy, and right the way through to the fact that, asset prices have held up very well. The wealth effect's been very strong this cycle. So, and the fact that even though the Fed hiked interest rates a lot, which historically has been very, very worrying, US mortgage rates have stayed low, right? Because lots of people locked in their mortgages, household debt service ratios have not gone up. So you've kind of had a lot of headwinds that's buffeted the economy over the last kind of, 18, 24 months. But essentially none of them have synced up to drag the economy into a recession. And now that the Fed is cutting rates and things are normalizing a bit, once the US election is done and the uncertainty is removed, actually, I think the economy is actually going to be okay. So, as far as we can see, we think the economy is kind of just growing a little bit below trend, but still positive growth. But most importantly, all the policymakers are very focused on the economy, and they're very ready to step in, which kind of helps to cut off the left tail a little bit.
So in your article, you talk about Schrodinger's, and I don't know if I'm pronouncing that right, recession. Can you explain to us what exactly that is and where we are with that?
Oh, yeah. So this is the very famous Schrodinger's cat experiment, right? Where he essentially says, you have a box, you put the cat with some poison inside the box. Before you open the box, is the cat dead or alive? Well, it's both simultaneously, right? Until you open the box that you find out. And I think that's been a very nice analogy for this post-COVID economy we've been going through, where we've had, various signs, right? There's been jumps in layoffs, right? Certain things like SARM rule, which is linked to historically jumps in unemployment that normally mark recessions, right? There's been some of these worrying signs, yet there's been some pretty good headline growth numbers, headline consumer numbers. So I think that's where the analogy to Schrodinger's recession comes in, where we had lots of differing factors. So it's simultaneously been a recession and not a recession. And I think what's been happening year to date so far is that, broadly speaking, a lot of the leading indicators in the economy have been stabilizing and recovering. There's obviously a bit of noise. This is a pretty consequential US election that's distorting some of the data. But broadly speaking, we're kind of saying if you lift the box now, it does look like we've weathered a lot of the drags that would have historically resulted in a recession. But due to the fiscal, due to the government intervention, due to the fiscal policies, due to the better household balance sheets, or the deleveraging post-COVID, they have helped to kind of hold things up this time around. So when you lift the box, it looks like no recession.
So Tian, if we're averting a recession, obviously the economy, as you say, is growing but slower. What's keeping us from entering a recession? If that's possible, actually.
Yeah, so obviously there's some pretty credible people talking about how the Fed's already behind the curve, right? It doesn't matter if they cut too late. So I think it's worth thinking about recessions as kind of a phase shift rather than like a smooth process, right? I think that the analogy is kind of like you boil water and boil it, and then it's that moment it turns to steam. That's kind of the phase shift when you go into a recession. So if you look historically, it's not like, growth goes from 2% to 1% to 0 to -1 and it's smooth, right? It's kind of a jump. And so the only situations in which these kind of jumpy feedback loop phase shift recessions happen is when everything aligns. So it's not just so much that growth is slowing, because growth slows and accelerates all the time. The key is that a lot of these feedback loop mechanisms are in place. So for example, if say the Fed was going to hike interest rates and credit spreads widen, then clearly businesses will have to pay more to borrow. And so if they start to struggle, they will lay off workers. If they lay off workers, then incomes go down, then consumption goes down. So more businesses' revenue get hurt, and that feedback loop kicks in. And then that's very hard for policymakers to stop. And that's what the recession is, right? It's kind of these feedback loops that accelerate and you get the phase shift. The difference this time around is that only really the start of 2023 met those kind of initial signs of a phase shift, which, after kind of Silicon Valley Bank, the Fed actually managed to step in and bail everything out, and they actually stabilized a bit and growth held up. And I think since then, none of these historically needed kind of sequences are actually in place today. So we're pretty much out of sync, right? We had the housing stress last year, right? In terms of transactions, certainly manufacturing was in recession last year. It's kind of coming, it's kind of stabilizing now. Obviously, there's some concerns around election uncertainty, but if you just look at delivery times, they're kind of picking up. Again, U.S. consumer, right? It's been fine. It's not doing amazing. People are clearly concerned about personal finances. Inflation and price levels clearly do matter. But in aggregate, the data's held up because it's been a pretty bifurcated consumer. The bottom 1/3 are struggling. Price levels, credit card debt stress, that really is a problem. but the top third have been doing pretty well. All their asset prices are up, house prices are up, right? They're selling low mortgages. The biggest companies done well. They locked in issue debt when it was much cheaper. So we haven't really had that feedback loop, that kind of, incomes falling, leading to more layoffs, right? That's kind of what's been missing. So in that sense, that's kind of what you would expect to see. And obviously we don't have a crystal ball. We can't see exactly what's going to happen in the future. But right now it doesn't seem that obvious. We're going to get kind of big income shocks that will lead to more mass layoffs that lead to more income shocks, right? Plus, as I said, when the government deficit is running 6-7% of GDP, and there's a lot of politically driven needs to spend money, right? Whether it's on entitlement, but also industrial policy, in the name of national security, that's a lot of spending to come. And that also, again, helps prop up the private sector balance sheets and stop, or at least ameliorate the worst risks of like these income layoff recession shocks.
It's interesting you said that the lower third of the income distribution they're struggling a little bit, and it would seem that with GDP is obviously what people are spending money on. If those people can't spend money, the bottom third, are we relying on the top third or half to spend more money? And should we be addressing, and is that what the Fed did when they lowered rates, is try and address the lower third, trying to bring them back up to a point where they can contribute more to GDP also?
Yeah, I guess the answer is probably yes or no. Yes and no. But I think the short version is that in general, the bottom third obviously going to have more of their income spent on necessary goods, necessity staples. So the bottom third actually matter for inflation quite a lot. But obviously the top third tends to make the big budget purchases, a lot of discretionary, especially a lot of service, travel, and so forth, right? That's kind of the typical pattern. So it kind of matters more for kind of the discretionary components. And against that, you have a pretty extreme shift post-COVID, where you initially have a lot of spending on goods when we're all, sat at home surfing the internet, going on Amazon. And obviously since then, there's been a huge shift towards service spending, and that's what's been rock solid. And obviously service spending and the service sector does employ a lot of jobs along with the government, right? And that's also holding up the labor market. So in that sense, that's actually been the underlying trend. Obviously, when the Fed acts, there's generally a lag from when they change policy to when it feeds through. So it won't be immediate, but the signaling is important. And the fact that the Fed is cutting when there isn't obvious signs of stress, that's the biggest difference. So you can interpret it as almost slightly preemptive, right? Normally, if you go back, let's just take, say like not everything is going to be like, 2007 and 2008, great financial crisis and stuff, right? But typically, usually central banks are cutting a lot after the data is really bad already and things are broken, and we're obviously in recession. And as you say, this time around, in aggregate, things are okay. So, I think it's probably more a signaling at the margin from the Fed that's important. And most importantly, it enables a kind of more synchronized global easing cycle from other central banks. The Fed's by far the most important central bank in the world. And when the Fed cuts, it allows everyone else to cut, right? So it's not necessarily a coincidence that China also ease afterwards, right? And the ECB is cutting rates, and everyone suddenly has a lot more scope to cut rates because the Fed's cutting. So I think it's probably more of these global impacts and the signaling that's going to be more important.
So if we go back to the analogy used of the boiling water, they didn't really wait for it to turn to steam before they threw the pasta in. They did that a little bit before to try and eliminate the turning to steam.
Yeah, absolutely. Like I say, if you go on just like go on Twitter or X now and you look on social media, there's a lot of vitriol and hate directed to central bankers.
Oh yes.
But some of that might be valid, some might not be. I mean, personally, I think Jerome Powell has shown himself to be an extremely pragmatic, real world person, right? He's not beholden to some dogma on how the economy should or shouldn't work, right? He's been responsive to the data. Has he made a mistake? Yeah, he said it was transitory, it wasn't, but he's been pragmatic and tried to navigate things well. And there's a chance for him to pull off essentially what Volcker did without engineering a massive recession, right? And I think he wants to secure that. I think the key difference is that the central bankers are also self-aware. They are aware that the economy's changed. Maybe the old models doesn't necessarily work, and they have to be data dependent. That's being thrown in their face as if, they're supposed to be these omnipotent people with a crystal ball, right? But, they're just regular people and they're trying to do their best, right? And I think Jerome Powell's actually done a very good job, in my opinion, in navigating through the last few years. If you had someone really ideological who's like, right, this is the Phillips curve, we have to have 10% unemployment to get inflation down 10 points, then yeah, maybe that would have been different.
I think that, if models obviously change, and for someone like you have to model things and use more data and stuff like that. So if the Fed just decided, we're just going to rely on the old models, there's going to be a big problem. Times change and things change. Obviously, COVID changed a lot of things. So those models would have to change. But
yeah, I mean, that's such a great point, right? So for example, we build lots of lead indicators for growth, inflation, policy for most of the top 30 economies. And we have various causal discovery processes. So it's like, the machine tries to figure out how inputs are changing. And you see it very clearly, especially in the US. As for example, in recent years in the US, services, new orders is a new input that's suddenly very important. And it's kind of intuitive if you look at the shift towards good spending initially and then services afterwards. And then, it's telling you things like consumer confidence is no longer predictive, right? Because again, we're a lot more polarized, right? Republican Democrats going to report consumer confidence according to their political leanings. So so you see it in real time how the models are shifting and the inputs are changing. And and that's in a way, it makes me feel better that someone like Powell talks about, being data dependent. It's a good thing.
Right. Yeah, I mean, data dependent. In your article, you have the U.S. probability graph of a recession, and for the first time in the last month, it's actually dropped below 50%. So that's a really nice graph that maybe we're not going to have a recession. But in your estimation, have we embarked on this soft landing that everybody's been talking about?
So the way we think about the economy, like I said. When we start to think about the economy, you have all these very nice quadrant graphs, right? The growth is accelerating and now we're slowing down. Then we have recession recovery. Again, that's true 80% of the time, right? Most of the time, the economy is a smooth wave shape and there's cycles. But then there's that jump process we talked about. That's a recession. So in that sense, the way we try and model things is we have these smooth cycle lead indicators, and those actually basically started bottoming out in August of last year already and started turning up. But you also have this 1-0 risk warning indicator. And as you say, that's just been, 50 and very volatile jumping, which tells you about how weird the environment it's been. And now that they're broadly starting to align, it does look like it'll be the quote unquote soft landing. But the key is not so much whether it's a soft landing. The key is, will that impact asset prices? Right, and this matters a lot because if you look at this year, if equities, I would argue, are probably largely discounted already. If you look at where earnings expectations are, and obviously after the very good non-farm payrolls numbers, bond markets have also realized and discounted it. Right, so we went from bond markets pricing in a pretty big recession, yields collapsing, to now pretty much yields normalizing around 10-year US yield around 4%. Feels about right. So now you're kind of back to probably a pretty decent environment for your 60-40, right? This is a necessary time to be a hero and make a huge lever bet either way, because I think asset markets are largely discounted it. And then from here, we kind of need to just observe and see if there's any kind of major deviation that comes up, right, before making the next move. So that's probably the more important question.
Tian, the Fed has started a rate cutting cycle. Do you think that the 50 basis points was enough? Was it not enough? Was it too much? Because the economic data seems to say that obviously inflation isn't where they want it yet at the 2% level, but it's I wouldn't say inching down, but maybe it's a quarter of an inching down. It's coming down, but very, very slowly.
So I think the actual the actual decision itself is probably less important than what it did to the markets, because obviously financial markets are forward looking. So in the money markets, what the Fed's going to do is priced out for the next few years, right? To the nth degree already. So the entire curve is moving. If you look at SOFR futures, Fed funds futures, is all there. And what the impact, and because obviously they surprised, the impact was they really, I think, caused quite a big stop out in the money markets and a quite a big shift where there was a bit of probably panic that what does the Fed know that the market didn't? So you had a very, very extreme move in discounting where, the market thought the Fed was going to cut to like 3%, like in 3.5% by the middle of 25. So like going super fast, right? So that initial decision might have scared people a bit, that people thought the Fed knew something and that they would have to cut super fast like they would in a recession. And obviously, as you say, since then, the data's been fine. And because the data's been fine, a lot of those moves had to come back out. And so now, if you actually look at where the money markets are, things feel about fair, right? I would say in nominal terms, so the Fed to cut the Fed funds rate to around 4% feels about right to get us to neutral. And I think as we mentioned, right, Powell has a window to do this. What's really important as central bankers, and that's why it's such a tough job. Not only do you have to predict what will happen with the economy, you also have to think about what the market's doing, and you don't want to freak the markets out, and you have to message it correctly. So in that sense, I think Powell actually did, again, the pragmatic things we said. The market was discounting a very aggressive Fed easing cycle. Whether you do 50 or not initially, the market definitely saw it into the middle of 2025. So Powell had a window. He took it. He cut rates without necessarily hugely upsetting everyone. Just it was a little bit of a surprise. And ultimately, his job is, now that inflation, as I say, is roughly done, right? It's no longer the kind of major issue. Right. Clearly, level's a little bit high, but the rate of change is good. He just wants to get interest rates down to a more neutral range, and again, be data dependent, right? And see how things go. But rates are a little bit high, so he just needs to get it down as fast as possible to neutral, and then from there observe. What is actually happening is that if you look at the Federal Reserve Board, a lot of the members there will give their projections for like the long term, where long term policy rates are, right? This magical, mythical R star that you'll see in the presses all the time. So, it looks like from the median, the Fed probably thinks the real neutral rate is more like 3 to 3.5 range, something like that. But on a lot of things we look at on the models, the neutral rate is probably more like 4% plus if you're talking about nominal policy rates. So there is a risk that if the Fed does, underestimate where the neutral rate is, they will cut too fast. And if you cut too fast, you might actually reaccelerate the economy in the second half of 2025, right? Just in terms of nominal lead lag. So it's actually looking more like that might become the risk now, than the other way around. But regardless, I think, again, getting to neutral as fast as possible makes sense because, one, Powell can secure his place as Volcker without the recession, and two, when the last thing you want to do is needlessly upset the market unless there's a very good reason. So if the market gives you a window, just try and cut and get to where you want to be as fast as possible.
So you see another cut coming in November.
Yeah, I mean, they should, right? Unless something big happens, right? They just want, I just think they want to keep going. But obviously, like, how much difference does any 125 bip or not make? Right. It won't be a huge amount, right? Obviously, basically, we're discounted to get to around 4 and under by Q1 next year. And that's the key, right? The key is not going to be whether they cut necessarily, but the messaging around it, right? Like, if you look at the press conferences, all the questions about, hey, Mr. Chairman, what do you think about this inflation number, right? Everyone's trying to get a sense of how quickly can we get to where they think the neutral is. Yeah.
So how long does it take for a rate cut to really make a difference? And I'll get to my next question about the bond market, but it seems that they cut rates, but the bond market went in a different direction than they thought it might.
Yeah, so this is, I guess, the in geek speak, you're talking about monetary policy transmission, right? like how effective it can be. So so if the central bank, especially if the U.S. Federal Reserve communicates well, they can obviously instantly move a lot of prices to where it needs to be, and so it can have a much more outsized impact than just from overnight rates that they, in theory, move. So in that sense, yeah, it depends on basically how much floating rate debt there is, who's sensitive to it, and then how well they can move the market. In general, in the U.S., the policy transmission mechanism has historically been pretty good. But like I say, this, I guess coming full circle, right? And if we look at, how the post-COVID cycle has been, a lot of, a lot of people's mortgages are much lower rates, right? So just because you start cutting, we're quite far away from where most people finance. So it's not we're not in that range where it's super sensitive, right? A lot of companies took advantage of the boom years after COVID when the government flooded the economy and markets with trillions and trillions of dollars, right? All these companies issued lots of loans, issued leverage loans, issued high yield debt. They've all locked in, lots of financing as well, right? So in that sense, it's probably become less sensitive, and that's arguably why the neutral rate is higher, and arguably why, even though the Fed has hiked rates by a lot since COVID, it hasn't had the typical, recessionary impact you would have expected based on history, right? The monetary policy transmission, right, seems to have diminished.
So I want to talk about the bond market a little bit because, I read your article on the bonds. It said, the 2s and 10s are getting a lot of attention because that price hasn't really dropped all that much. But if I'm correct, it's the 3-month bonds that the Fed looks at, against each other when they're looking at interest rates. Am I reading that correctly?
Right. Yeah. So this is linked to the conventional wisdom is that the yield curve is one of the best predictors of recessions, right? It's kind of undefeated. It will eventually be right. And what we've seen this time is that the yield curve has had one of the longest period of inversions ever without recession. But the argument goes normally when it uninverts, i.e. when the 2-year yield goes back below the 10-year yield, that's normally the beginning of a recession. The Fed researchers did a lot of work on this before, and what they found is that the main curve they actually look at is the 3 months interest rate against the 3 months interest rates 18 months forward. So it's like a forward space rate. So effectively it's saying, what does the market think 3 months rates are going to be 18 months from now, very roughly, right, versus today? And is it going to be higher or lower? And that curve and that uninversion they found is more predictive of recessions. And so that curve hasn't moved, basically. That's still kind of pretty inverted as of right now. But obviously things can change. And it's also just worth bearing in mind, again, when we live in a world where there is a bit more uncertainty around inflation, right, in terms of the volatility of inflation, that will affect how good nominal yield curve is. And also, the market is not fully self-determining, right? We know the Fed does QE, QT, they can impact the amount of bonds in the system. The Treasury in recent years has changed how they issue bonds. So a world where there is inflation, that will affect how good nominal yield curve is. And also, the market is not fully self-determining, right? We know the Fed does QE, QT, they can impact the amount of bonds in the system. The Treasury in recent years has changed how they issue bonds. So they've gone from issuing very long duration, long dated bonds to issuing more short-term bills. And so again, that's taken kind of the supply of duration away from the market. So there's been a bunch of these things that's happened that's impacted the kind of supply of bonds available for kind of private sector to invest in. And so the net result has actually been to suppress a little bit the what's called the term premium, essentially just the additional risk people put on longer dated yields. So there's like a bunch of these things that's kind of kicked in. So it's more saying the twos tens might be a bit more noisy than historically, right? You certainly shouldn't be relying on it as the main thing.
Is the bond market something somebody should be thinking about investing in right now, or do you think those rates are going to continue to come down?
So I guess it depends on the time horizon, because obviously much of the hedge fund industry, especially if you're a global macro PM, speculating and trading on these is kind of a very big part of the job description. But I think if you're an individual longer term investor and you don't want to stare at your screens every day, you probably need to look 1, 3, 5, 10 years ahead, right, in terms of where you want to be. And I think that's where the problem kicks in, because we know another big legacy of COVID is that, we crossed the Rubicon, right? Fiscal policy is okay again. And it's very easy for governments to turn back to it when there's a emergency, right? So, I think the analogy is very similar to the Fair Treasury Accord that started in 1942, where again, the emergency was to fight the Nazis. So that's when the central bank has to step in, help finance government debt. The government issues a lot of debt to do all the things they need to do. And in the name of a very important moral cause, right? And so with COVID became this emergency that was a moral issue, and therefore, regardless of all these concerns we had around deficits, we have to step in. The government has to increase their deficits, and what you're seeing more and more is that there's more crises that, whether real or imagined, that can happen, that can justify why the government needs to spend money on Project A, Project B, Project C, right? You don't hear the Tea Party anymore, right? There's not much of a voice against it, and it's a pretty global synchronized path where, I think in the future, when there is crisis, when there's economic downturns, it's much, much more likely fiscal policy will be used rather than just monetary policy. And obviously, if you issue a bunch of government debt, it will be a bit more inflationary, right, when you start doing that. So I think that's like a pretty big regime change that does make nominal bonds pretty unattractive. So, there's a reason gold's doing well, right? There's a reason you need real assets in your portfolio. If you need fixed income, you can look at mortgage-backed security, especially agency mortgage-backed securities, right? You don't have credit risk, same credit as a government. You get a bit of a pickup. Looking at tips, right? So you're protected in terms of get some inflation protection. So I would say, yeah, like for most investors practically, if you're not close to retirement, you need to lock in certain things, right? If you're not buying annuities and stuff, I do think the world we're going to, it's hard to see how governments don't want to spend money. It's funny, right? And obviously we'll talk about China, but it's kind of like, obviously China's a big thing, especially since she's come to power. And before the thinking was, China's joined the WTO, the US and China will converge. But in everyone's mind, the convergence is Chinese policy will converge all the way with the US and we'll have this system. Instead, if you look at in the real world, the convergence actually happened a little bit this way, right? US is also doing industrial policy, right? US is also intervening a lot more into economies, right? The US is directing more where credit goes. Those are like more Chinese style of managing the economy than not, and that's the convergence we're seeing.
So we went to them; they didn't come to us.
Well, it's probably a little bit of both. It just probably wasn't China converging.
They met in the middle, I guess. Yeah. I was reading an article, Tian, that said that our dollar buys more groceries now than it did in 2019. Did wages go up that high to meet prices? Because when I go to the grocery store, that's not what I'm feeling.
Really? Yeah, I'm surprised. I guess it depends on I don't know, right? That doesn't sound right to me, but maybe you'll change your basket. Maybe instead of your fancy luxury branded soap, you just bought the most basic, and that ends up being the same. Because obviously, price level is the price level, right? Inflation is a rate of change. The price level jumped, that hasn't come back. And wage growth has been somewhat uneven, depending on what sector you're in. So again, this might be a bifurcated consumer composition impact, I suspect.
Right.
I'm quite surprised by that.
Yeah. So let's talk about China a little bit. I know that you're skeptical about the stimulus, but what is happening with the Chinese economy, and how is that affecting the global economy?
Well, yeah, I mean, I think the framing when it all kicked off on that Tuesday morning was, I think this is a tradable bazooka. And tradable means next 1 to 3 months. So regardless of what you think on China, if you can be flexible, there's money to be made by buying it, right? So I framed it as it's a tradable bazooka, but not a real economic bazooka, in the sense that economic bazooka is where China would need to really address a lot of their structural economic problems quickly. And if you address it quickly, then it's not a case of where the Chinese equity is going to be up 50%, right? If you address the economic issues, then you want to buy Chinese equities because it's going to be up 300%. That's the difference. So I don't think we're there. I think for Western investors, you don't have to invest in China, right? There's other things to do. So the one option is, and it could be the right answer, just, yeah, whatever. It is what it is. I don't need to participate. If you want to participate, I think the thing to realize is, I think the Chinese way of thinking and doing things is a little bit different. You know, Western policymaker bazooka literally means bazooka. Like you're gonna know what we're gonna do now. It's gonna be upfront. You'll know the size, the amount, the impact. The market will discount it, and we're away. I think in the Chinese kind of, MO, the way, the phrase is typically like crossing the river by feeling out the stones. So decisions made, we try things for a bit, we see how it goes, we do things a little bit more, things go through some committees and this gets signed off and we do more. Like you do kind of eventually get there, but it probably isn't as, flash bang wallop exciting that, yes, this is resolved now. And I think that's one of the probably gaps in what's going to drive a lot of the volatility. But obviously the structural problem is extremely well known, right? At this point, we're like 3 years into this. So it's not like anyone is not aware of China and the problems. But I do think, the analogy is probably somewhat similar to when they ended zero COVID, that clearly the pain point was there, had been hit for the authorities in terms of local government, finances, in terms of the economic stress and, unemployment, youth unemployment, things that matter socially, right? So I think because those pain points were hit, again, like any government, it's very reasonable for them to want to do something about it, right? And that will clearly be beneficial for shifting the narrative, stabilizing the economy. Obviously, there's a lot of policies to try and boost equity prices, like directly, facilities for people to borrow money to buy equities is pretty direct. So in that sense, I think it's pretty tradable. But I don't think this spells the major change in how China wants to operate and how it sees itself in the world, right? Like, the phrase like capitalism with Chinese characteristics, right? There's a different order of priority, I would say. It's not just about profit maximization and growth maximization, right? Like there's a lot more concerns around national security, food security, energy security. If you look at how many solar panels China's building, right? They want to reduce their dependence on importing oil that comes from the Strait of Hormuz that, if an adversary wants to cut you off, you just cut off, right? There's tons of more, I guess, real world geopolitical things that I think they deem as important. And that obviously takes slightly higher priority than the economy. So it's like a balancing act.
Do you think the stimulus that they had announced was enough? I mean, if they're crossing the river stone by stone, as you said, it seems like, well, maybe we'll move slowly and try and move this along. But China's economy has been not so great for a while. Does it need a bazooka, like you say, to get it moving?
Yeah, I think they've pretty much done all they can on the monetary policy side, and that's not going to be enough, right? So everyone's obsessed with fiscal policy. I think order magnitude wise, yeah, you need, the numbers bandied around are like, 2 trillion, 3 trillion, 5 trillion RMB. So to give you an order magnitude, that's around, 3 to 5% of GDP worth. I think if they go towards 5% of GDP, that might start making a difference, right? Because the economy is in such bad shape. You need some mega amount to shift the needle. So, it could happen. I think that, as I say, we're at a breaking point in terms of we're not breaking, but the pain point, right? That the authorities want to react, but it's going to take a lot. And I don't think there's a long-term change of direction. So that's why it's more just, it's almost a bit like, obviously, we have to talk to a lot of clients about this, and then obviously I have a lot of friends, and obviously a lot of people care. And it's kind of like, in your system, how important is the market, right? You should just ask that, like, is the market as a allocation mechanism, how much do you respect the price? If you truly let market prices allocate everything, then you truly believe in the power of the invisible hand and for the efficiency. I think in China, the market is just viewed as one tool in the tool belt.
Right.
So when the economy is not doing so well, they need some stuff, then you can maybe go to the private sector, go to the market mechanism a bit more. And then when you don't need it, you probably don't need as much. And I think that's probably the biggest mindset difference that we'll have to see if it shifts. But yeah, if it doesn't, it's hard to be too structurally bullish. But for a trade, and in terms of how much everyone hates it, yeah, I mean, there's no reason why we wouldn't rally, to year end, beginning of next year, right? Even.
Yeah, because when they announced the first round of stimulus, their market shot up 20% pretty quickly, and then came right back down when it was announced, well, there is no more stimulus. Now they're talking about more stimulus, and it might be. Could it be a time to sink some money into Chinese equities, let it ride up, and then pull it back out again?
Yeah, like I said, I think from an allocation point of view, allocation means you buy, and then you don't have to stare at your screen every day, right? It's not like, so if you happen to go on holiday, you miss it, suddenly it's back down 20%. That's not really what you want. So I think from an allocation point of view, I would be pretty skeptical right now. But obviously from a trading point of view, yeah, I think there's going to be a drip, drip, drip of more announcements to come. The difference now versus next year, right? Even.
Yeah, because when they announced the first round of stimulus,
next year, right? Even.
Yeah, because when they sink some money into Chinese equities, let it ride up, and then pull it back out again.
Yeah, like I said, I think from an allocation point of view, allocation means you buy, and then you don't have to stare at your screen every day, right? It's not like, so if you happen to go on holiday, you miss it, suddenly it's back down 20%. That's not really what you want. So I think from an allocation point of view, I would be pretty skeptical right now. But obviously from a trading point of view, yeah, I think there's going to be a drip, drip, drip of more announcements to come. The difference now versus I think any time in the last 3 years is it feels like people want to believe. There's this interesting situation we're in where, there's always something for the bulls and the bears, right? Those are, when the policymakers report, they're off, right? The people who are optimistic, they point at these things. Oh yeah, this is, you see what I told you, this coming. And then the people who are bearish are like, see this, they didn't do this. I told you this is going to go bad. And they seem to be doing a good job of giving a little bit to both and just keeping it going. So yeah, that's why I think overall, I think the direction of travel is more fiscal coming. It's probably not as much as the market wants. It's probably not the all-in consumer stimulus they want, but I think it can boost asset prices for a while. Yeah.
So is it in your research, is there a particular sector or region that you find most attractive for investments?
Yeah. So the way we do it is we essentially try to stack all the kind of most important models we have for the macroeconomy, for longer term industrial capital cycles, and different models for crowding and positioning, right? So in that sense, we try and marry it all together into kind of an engine that we can spit out weights on. Obviously, for the context of this particular call, I think, I think the key is to not necessarily take massive 1-0 binary risks and to try and unnecessarily be a hero, right? The key is to protect capital and compound it slowly over time. So the version of the engine we have for that recommends, pretty much right now, if your benchmark is, say, 60-40 equity bonds, stick to benchmark. Within sector tilts, is tilted more towards like communication services, staple, and a little bit discretionary. And the underweights are more heavily concentrated in kind of like financials and healthcare, and a little bit industrials, right? So you can see it's not necessarily full on, risk off, or full on cyclical or defensive. It's more trying to look for a bit of relative value and a bit of relative allocation right now to give you a little bit extra performance. So that's more the kind of tilt in the model right now.
So what's your feeling on gold? Gold is reaching new highs, and commodities. Obviously, our government here in the U.S. is not going to stop spending money. So gold could be a decent bet against some stuff. But what about commodities as well? Or they've been suffering for a good portion of time. Is it time to start thinking about commodities again?
Yeah, so I think gold is just, you should have some gold, just like a core allocation, right? It's like a clean, real asset that should cover us for, you know, the risks around fiscal profligacy and, you know, more of those things we talked about, right? Gold is kind of your defensive asset if government bonds don't work anymore, right, in future downturns. So that's why gold, I think, is relevant structurally, and that's a core holding. On commodities, I think it depends. You probably have to be a bit more granular than just buying the commodity ETF, because I do think, as I mentioned, right, on things like China, it's not super clear that oil demand is going to surge a lot, even with China stimulus, because they're trying to wean themselves off oil a little bit. At the same time, obviously, there's a lot of supply coming on board. OPEC is struggling a little bit to keep the quotas together, right? So you don't have a very good outlook on demand supply. Yes, the US does need to refill its strategic reserves, but why would US not? You know, what if Trump wins? You know, MBS in Saudi Arabia goes, oh, okay, you know, I want to maintain market share, you know, and then oil prices crash, and then Trump fills up the SPR, and then goes down. One of the best oil traders ever, where you drew it down and bought it back, right? It could happen. So yeah, I think oil is pretty tricky. I wouldn't think that's very interesting. If there's things that are strategically important and in limited supply, things like copper, rare earths, things linked to the renewable transition, cobalt, lithium, all these things, I think those are potentially more interesting depending on, you know, the kind of producers that you can find, right? So I'm not that interested in iron or oil, because that's a pure China play. And as I say, I'm skeptical China's really going to go back to the same old real estate infrastructure-led kind of boost to growth. But certainly for gold or some of these other things that are more geopolitically important, yeah, you know, I think there's good opportunity there.
Well, Tian, thanks so much for joining me. I really appreciate it, and the great insights. And you know, I love to read your stuff. I think it's great. Where can we find you, either on social media or your research?
Variantperception.com, right? And you know, you can find us from there. Obviously, we're on Twitter. We're probably not as active on Twitter as some other people, but you know, we try and put out a few charts a day, keep it focused on the data. Don't get too involved in some of the personal elements on Twitter. So yeah, variantperception.com.
You keep it professional, is what you're trying to say.
I don't think I'm smart-witted enough to win those Twitter fights.
Yeah, I don't think anybody wins when people get into those Twitter wars. But you know, thank you so much again for joining me. I really appreciate it.
Thanks for having me.
Thanks so much for watching our discussion here on Wealthion with Tian Yang. He certainly has opinions on markets and the facts to back them up. If you need more facts and help being financially resilient, head over to wealthion.com/free for a free, no obligation portfolio review. And of course, if you could like and subscribe to the channel, we would.
Recession by Wealthion. Monday, October 21st, 2024, 15:20. Wealthion's Andrew Brill sits down with Variant Perception CEO, Tian Yang, to unpack his intriguing concept of a Schrodinger's recession, where the U.S. economy continues growing despite